Hello, all my kits and cubs. You're watching foxwithstocks.com. Today is January 12th, and we'll be looking at Doordash, stock symbol DASH. Now, please read our disclaimers as I give us today's words of wisdom. People will go over $100,000 into debt for college, but still won't invest $5,000 in a stock because it's quote-unquote too risky. Now, why are we going over Doordash? I'm looking for the next great company like Tesla for a long-term buy and hold. But today, we're going to use it as an example for trading stock options because no matter what company I'm looking at, I want to take a look at their stock options. Now, the way I found and got more interested in Doordash was I found this great channel called Candor. She runs a kind of a recruitment service that helps people in the Valley, that is San Francisco, by the way, negotiate for higher salaries. And Nia is super positive on Doordash. She really likes the team there. There is obviously conflict of interest because she has placed clients there, but that actually gives her some additional insight into the company, how well they're doing, etc., etc. And I think you should watch her channel or watch this video. So I'm going to put a link for it in the description below. And I've already subscribed, and perhaps you should too. So let's take a look at Doordash, currently trading between 167 and 167.35. It gained $11 yesterday, so good job for all you who have already bought and held. And if we look at the put sells, I noticed that there's a pretty good return around the 145. So let's go ahead and break that down. Now, unfortunately with stock options, you're going to listen to me rattle off a bunch of numbers. But the more you listen to these, the more that you practice and do on your own. And maybe you should start with paper trading or start with real cash or small cash if that's what you prefer. But the more that you do these, the more that it just gets quicker and faster to do them on your own and to understand the importance of each of these. So I'm going to try and relay some of that today, but unfortunately, there's just no getting around this rattling off of numbers. So let's get to it. As I said, today's January the 12th, 2021. Today's stock price is at 167, and we're looking at the strike price of 145. Now remember, in a put sell, the strike price is the amount that we would have to buy the stock if it goes below that amount and becomes exercised, gets put to us. Now, I'll explain in a second more about the break even, because we really wouldn't own it for 145. Because we'd have to subtract our premium. Now, if we look at the premium, there's a pretty wide spread going on here, partially because the market's closed, and it's between $7.40 and $8.20. Now, that's per share times 100 shares. But I think we might be able to get some fill in the 760 to 770 range because the gap is so wide. But for our calculation today, we're going to assume that we get the bare minimum of 740. And if you look, our theta is 17.72. It's not on the screen capture that I have, but I already looked it up. That's the amount of money that we would earn every day as this stock option gets closer to expiration. The expiration I chose is February 19th. That's in 39 days. Typically, we'll do in 25 to 45 days when selling our stock options, selling puts specifically, because that gives us the right amount of time for decay to work in our favor. It's not too long. If you go too far out, if you go past 60, 90 days, the theta decay is not as high as it would be, so you're not making as much money per day. You're also opening yourself up to more days for some news or some catalyst to affect the stock market in general or to affect the stock that you've sold. So you want to find that distance where the window is small but not so small that you're not making enough money. So 39 days is a good number for us on this particular stock. Now, if we take the premium of 740 and divide it by the strike of 145, we get an ROI of 5.1% in 39 days. Now, if we calculate that out, so if we want to be able to compare this to our other investments or other option choices, should I sell the 30-day, the 39-day, the 45-day? we need to convert that ROI into APR. So we take 365, the days in a year, and we divide it by the days on our option, so 39. And then we multiply it by the ROI, 5.1, and we get an APR of 47.7. Now, BE stands for break even, so I want to find out if this got put to me, what would be my dollar cost average or my break even point on this put option. So we take 145, which is the strike price. We subtract the premium, which might get higher. We might get filled at 760, but we're going to assume we get filled at 740. And we end up with 137.60. Now, CBD is something that I came up with. And no, it's not cannabis oil, okay? CBD, I've never seen anyone else talk about it. I'm sure other people use it. I'm sure hedge funds use it, but I've never seen any books or articles that clearly define this formula and put a name to it. So I went ahead and did it. If you know that there's a name that's pre-existing out there for this formula, then please let me know in the comments below. But until then, I'm going to assume that I might have actually been the first to come up with or at least put a name to this formula. And I use this a lot, so I want you to know what it is. The cost basis distance takes your break even, 137.60, and divides it by today's trading price of 167 to come up with a percentage. Now, because we're selling the put, we need to invert that CBD, and we get to 17.6%. That means, let me explain the power of this. That means the stock price would have to fall 17.6% before you start losing any money. Okay, so if you sold this put and the stock went down 17%, you would still make money because it would close. Even if it got assigned to you, you would still make money because you have not reached your cost basis distance. And it's a pretty simple formula once you know about it. I mean, you're already calculating your break even already, but I've never seen anybody put this into percentage terms, and it blows my mind that it wasn't out there. And I use this a lot, and so should you. And then finally, we have our POP, which is 72%. That's defined by the platform using Black-Scholes. So that means that if we make this trade just based on the volatility of the stock and the duration that we've chosen and the price and everything else that's gone into it, there's only a 72%, sorry, reverse that. There's a 72% chance that we will not be assigned and we will be profitable in this trade. Okay. Now, the inverse of this is the guy buying it. So the guy who's buying this put, he only has a 28% chance of making any money. Okay. And that's just to start making money. To make even a penny, he has a 28% chance. Now, if you take a look at this, this is an expensive stock. I'm not recommending it, and I'm not doing it in my own portfolio. We're just using it as an example today. The reason I wouldn't do this one is just it takes up so much of my portfolio that I have set aside for put sales, and it would take up $13,760 for 39 days to make this trade. You'd get a max profit of $740. Now, if this is a great company and you're super bullish on it, then maybe you would want to consider it if you were going to buy the stock anyway. Now, I want to go ahead and compare this to buying a call. Because if we say that this is such a big growth company, that it has so much potential, then we should look at the calls and not just the put sells. So I went out and I found a good call. I'll go over the numbers first, and then I'll tell you why I think that this would be, if I was buying a call, this would probably be the call that I would buy. But I'm not going to buy this call. At least I don't think so. I'll continue to do my research. So never say never, right? Again, price is 167. The strike that I went out and chose is 110. Okay. So, and I'll explain why we chose the 110. It's mostly to do with the delta. I want my delta to be at least or as close to 0.9. But I went ahead and chose 0.88 because it's close enough, and the bid ask is significantly better, and I think. The premium that we'd have to pay to buy this is $63 a share. So we're not getting a lot of leverage out of this. We're getting close to 3 to 1. which is another reason I don't buy a lot of calls. Um, it will continue to discuss this, but it would expire May 21st. It's 130 days out. Our ROI is undefined. We have no idea how much money we would make if we bought this call. Whereas if you sell the put, let's go back. If you sell the put, your ROI is capped, but it's also predefined. You know the moment you make this trade what your ROI will be, assuming that you don't get put the stock. If you get put the stock, it can actually be even better for you. Recently, I had a stock that I was selling puts for over a number of months. It got assigned to me. I thought it was going to be a huge loser. I thought I was going to lose a ton of money on it. And then they rebounded off of news because they bought a Bitcoin farm. Actually, they started mining Bitcoin, as funny as that may sound. And they tripled the stock price off of that news. And so for several months, I was making 5% a month selling the puts. Then it got assigned to me. And then it tripled in price. I mean, how good is that? But when you're selling puts and you don't get assigned, your ROI is capped. Whereas if you buy the call, your ROI is undefined. Now other people say it's infinite. Yeah, infinite is such a misleading word. Stock prices don't go infinite. You're never going to get an infinite return. I prefer to use the term undefined. Okay, the APR is undefined. Your break even, and this is the reason I chose the 110, because you get a nice 0.88 for the delta, okay? And if you take your break even, you take 110, which is the strike price, and you add the ask price into it, you get 173.40. Today it's currently trading at 167. So you would only need to go up $4 in order to start making money. And I might have done a miscalculation on the CBD here. I'll take a look at it later. So my CBD is telling me that I need to go up 4%, 3.8% before I start to make money on this. And I'm kind of doing the math in my head here. No, okay, actually that's right. Yes, because 167 adding $7, we're about 4%. Now here is the bad news, and the reason why I don't do a lot of calls, I don't buy a lot of options, I am mostly a seller of options, is the pop is only 38%. Now if you have some insight into some future event, some catalyst, that's the thing about these pops and these Black Scholes models, is they do not and cannot calculate the impact of a future event. So if you know, for example, Tesla is a great example, we knew ahead of time when the S&P inclusion was going to be done in December. You could have bought calls, you could have seen the pop and realized that that pop is incorrect because you know what the news is, and if you have a biased opinion or if you have an idea of what's going to happen, what's going to come out of that, then this pop becomes less and less relevant. It's actually it's almost an indicator of how cheap you're getting the call option. Okay, so if you have some great information on Doordash, please either comment below or message me directly. Sign up for our newsletter. Get a hold of my email address somehow, and please tell me the amazing news you have on Doordash, because of course I want to know. All right. Now the max loss on this is we take our premium and we multiply it by the number of shares we would have to buy. So we have a max loss of $6,340 and an undefined max profit of max profit of undefined. So we don't know how much money we can make off this. We could risk $6,340 and make quote unquote unlimited or undefined amount of money on this. So let's do a side-by-side comparison. I don't know how to do a side-by-side comparison. It's the first time I've ever done it. But you can see that in one case we're looking at a call option that we're selling and it expires in 39 days. And so in 39 days, you will either make 5.1% or you will be the proud owner of 100 shares per contract at a cost basis of $137.60. Now, you would have a 72% chance, based just off of Black Scholes, not based off of news and catalysts, etc., of being profitable. You would be risking $13,760 to make $740. But the good news is that the downside, if you're wrong, right? Let's compare these. On one of these, you have unlimited potential, okay? but if you're wrong, you're going to lose $6,000. On the other side, if you're wrong, you're not going to lose 13,000. Well, you're not likely. Okay, you're not likely going to lose $13,760. In order for you to lose $13,760 on your selling a put, the entire company would have to go bankrupt and the stock would have to go to zero. So not only would it have to go bankrupt, the stock would actually have to go to zero. If you remember Hertz this year, it went bankrupt and then went up in price. Okay, so you need both things to happen. You need the stock to go to zero to lose the 13,760. If you're wrong when you sell a put, the first thing that happens is you now own shares, which is why it's such a powerful strategy, such a safe strategy. It is literally mathematically safer than buying the shares. Let's compare. Let's ignore the call option for just a second. Let's go back to selling the put. If you were to buy 100 shares today, you would be risking $16,700, and if it went to zero, you would lose all of it. And the same situation, if you sell a put and it goes to zero, you would lose all of it. But you would lose $6,000 less because you would only be losing $13,760 instead of $16,700. Okay, it is mathematically safer to sell a put. And you may be going, Bud, why are you putting so much emphasis and talking about this so long? It's because I constantly run into people who are not familiar enough with options, who might know about options and they might buy options, but they are so confused and mostly misled, I truly believe misled, that selling puts is somehow risky and dangerous. Selling puts, especially when done correctly, selling puts is safer than buying stocks. Mathematically safer. I've literally just told you it's mathematically safer and shown you. I've mathematically shown you that it's safer than buying the stock and holding long term, because that is the first downside. The first downside of selling a put isn't that you lose your money when it expires. No, the downside for selling a put is that as it reaches expiration, it gets assigned to you and now you own shares. So there's literally a layer of safety that you get that person buying the shares does not get. Also, you are in this trade for a predetermined amount of time, right? If I buy the shares, I could sell or exit at any time. Now that's kind of okay, so there is a trade-off there. If it starts to tank and I have a stop loss, you could start selling at a stop loss and you could lock in those losses. Whereas if you sell the put, no, it's not true. Actually, you know what? I take it back. It's not true. If you sell the put, you can buy the contract back and close it early. You could theoretically have a stop loss that goes the other direction. That if the price starts to go down and the option price goes up, it's kind of, you have to think about it inversely. If the option price goes up too much, you could exit early. You could put in a stop loss for as the option price climbs to buy it back before it reaches a level that you're not comfortable with. I don't personally do that because the setups that I create have so far, over a 90% chance of being profitable. That means 9 out of 10 of these trades, it just expires in my favor and I collect the premium. So far, and past performance is no indication of future blah, blah, blah. But so far, the ones that do get assigned to me, 9 out of 10 times I'm able to sell the call and earn premium over and over again that I break even or still turn profitable. And very rarely have I sold a company. It has happened, unfortunately. There was a European bank that I invested in that went belly up, and that is now delisted, and I will probably never get any of my money back for that stock. But that is 9 out of 10 times it doesn't even get put to me. 9 out of 10 times I'm able to sell the call. So whatever mathematically that works out to, that is the amount of times that I've had to just eat it. Now, the reverse. If you buy this call, you need to make profit in 130 days. This thing needs to move in your direction. So not only do you have to be right that it's a good company, it's going to go up, but it has to go up in 130 days or less because you have already bought the option. That premium, right, this premium is already spent. It's already gone, right? When you sell a put, this premium, $740, it's already added to your account. This money goes into your account. This money goes out of your account. Here we go, premium. This money goes into your account when you're selling a put. This money goes out of your account when you're buying a call. Now, when you're selling a put, you do have to, your broker will lock up this amount of money when you're selling the put. But when you are buying a call, you are spending this much money. Those are the differences, right? And personally, I've had better success, and I like the mathematics and the formula and the layers of selling, because over here, I have a 72% chance of just never getting assigned shares. And over here, you only have a 38% chance of ever seeing a dime of profit. Okay? This is why I don't buy the calls. And to me, this isn't a cheap enough call. Even if I was really bullish on this company, if we look at it, I'm putting up $6,000 to control $16,000 worth of shares. In my mind, if you're going to do this, why would you do this? Because you could just have a margin account on a stockbroker, probably get 2 to 1. So you would get 2 to 1 leverage instead of 2.5 leverage, but you wouldn't be timed. There would be no time decay on this. You would not be limited to making it for 130 days. Now, of course, there's lots of call options that you could look at. You could look at the 7-day call option, deep out of the money, over $200. Let's go look at something, right? Excuse me. So we go back to it. Okay, you could come down here and you could buy the $230 call for $3.70, expiring in 39 days. That's much less risk, right? You could be putting up the money for it, but it would need to move in 39 days. And if you really wanted to reach parity and break even, it would have to climb from $167 to $233.70. So the strategy that some people use is that they buy this with no intention of coming anywhere near the 39 days to exercise. They buy it deep out of the money and try and profit off of the option price increasing in a short amount of time. It's a super risky strategy, but it doesn't take up a lot of capital compared to the other options that I've shown you. Okay? If you have some significant news, some significant insight, then maybe buying the call here or buying the call deep out of the money could be a good strategy. Or you could do it with a small percentage of your portfolio. You wouldn't want to do it with a large percentage of your portfolio. It's not safe. I'm able to take this. I would do this in a large portfolio. I've set aside a certain amount of money. I've set aside actually $25,000, which I've grown to $35,000 over the last 9 months using just this strategy. Finding good companies, finding good trades. And this one, by the way, does not meet my criteria. I'm not doing this trade, okay? Because it's not 5% in 30 days, it's not an APR of 50%, and it's not a CBD of 20%. I've gone ahead and told you that the formula that I'm looking for. Now, those are guidelines. I'll adjust if I think it's a really great company, but I haven't done the research on Doordash to figure out if it's great enough to adjust and if it's great enough to put up this type of risk. I'm looking for a max loss of $5,000 because of my account size. If I had 10 times the account size, then this max loss wouldn't matter. I would still be looking at these numbers. Okay. I hope this has been an informative video going over the process of analyzing these stock options. I'm always open to more information from Doordash. I spend a ton of time doing the research on these stocks, but you know what? You guys have access to different types of information. You guys have access to articles that I might not have ever even seen, or you might have a cousin, brother, sister, roommate that works at Doordash, right? I want you to join us. I want us to be able to share this information that we find and better ourselves. So I'd really like it if you liked and subscribed to this video to help this video reach more people. But even smarter is if you sign up for our free newsletter at foxwithstocks.com and we begin the conversation of working together and finding great trades together. Thank you so much for watching this video. Have a great day.